Now, the next part here is because your home is part of your FIRE, your financial independence, retire early, we're also going to be seeing how this is going to affect your ability to retire. So with taking the annual living expenses, so this excluding mortgage, so let's say that the present value of that is $24,000 or $2,000 per month. The annual inflation rate of 2%, the future value of this in 20 years time when you retire is going to be $35,663 annually. Now 4% or 25 times is the standard multiplier in order to estimate what your retirement fund would be based on your living costs. So the total cash that you need at retirement would be $891,000. Now let's say in order to have $891,000 at the time of retirement, how much would that value be at present value? So let's say with the 7% market rate return, you would need $220,754 in order to compound this at a 7% rate on a monthly basis in order to reach $891,000 in 20 years time when you retire. But let's say you don't have this amount right now and you actually need to be more proactive about saving towards your retirement. In that case, you would need to set aside monthly savings of $1,712, and that means that by the time you retire, your total savings that you put towards retirement is $410,761, but because of the compounding that occurred over time, you will reach your $891,000 fund. Now you can see that if you don't have this $220,000 investment that you could set aside until retirement, you would actually need to save almost double that amount over the course of 20 years. And that difference is $190,000. And this really plays into the effect of compounding has if you have a long time horizon. You can close this gap by trying to save as much as possible in a shorter amount of time so that you can let compounding do a lot of the heavy lifting.